This is part 2 of the Tax Cuts and Jobs Act and its effects on individual tax returns. And we'll pick it up from above-the-line deductions. As far as above-the-line items, prior to the Tax Cuts and Jobs Act, moving expenses were deductible if they were work-related, a distance test was met, and a time test was met. There were also various criteria as to what was included as a deductible moving expense. Going forward, only members of the armed forces on active duty can deduct moving expenses. Prior to the Tax Cuts and Jobs Act, $250 in certain expenses were deductible for teachers as an educator expense, another above-the-line item. This was available to both taxpayer and spouse if both were educators. Going forward, the education expense above-the-line deduction has been increased to $500, and it remains available to both taxpayer and spouse if both are educators. In regard to alimony, prior to the Tax Cuts and Jobs Act, alimony received was considered income, and it was reported on the Form 1040, line 11, as alimony received. Alimony paid was reported as an adjustment to income, and it reduced adjusted gross income, or AGI. The amount of the alimony paid was reported on the 1040, line 31A, and the Social Security number of the recipient of the alimony was reported on Form 1040, line 31B. Starting in 2019, for any divorce agreement or alimony modification agreement that's executed on or after January the 1st, 2019, alimony received will not be considered income. Alimony paid will not be considered an adjustment to income. Any alimony received or paid under a divorce or modification agreement that was executed on or before December 31st, 2018 will be given pre-TCJA treatment. The domestic production activities deduction will go away. Pre-TCJA, this was an above-the-line adjustment wherein a deduction of up to 9% of certain income could be deducted for engaging in certain manufacturing, mining, and production activities. Typically, this was a pass-through item on a K-1, and it was most commonly found on a publicly traded partnership. It required completion of Form 8903. And again, the TCJA eliminated this deduction for individuals and pass-through entities effective for tax years starting after December 31st, 2017. The domestic production activities deduction has been eliminated for all entities, C Corps filing Form 1120, effective tax years starting after December 31st, 2018. Continuing with our discussion of above-the-line items, net operating losses. Now, pre-TCJA, a taxpayer could elect to carry a net operating loss, or an NOL, back 3 years, effectively 2 years back, since the 2017 loss would go back to 2015. This was done on Form 1045, a very difficult form to deal with, application for refund, or by filing amended tax returns. The taxpayer not electing to carry back an NOL would have to carry the loss forward and could carry the loss forward up to 20 years. The TCJA has eliminated the option to carry back a net operating loss. Very important. Going forward, NOLs can only be carried forward indefinitely until they're used. However, a net operating loss carried forward can only be used to deduct 80% of the future year's income. Special rules regarding net operating losses have been created for farming losses that will still permit carrybacks for farmers. As far as debt cancellation, pre-TCJA, student loan debt cancellation is considered income. Going forward, student loan debt cancellation due to death or disability is not considered income. So, the modified other deductions and credits, continuing on with our table, added $47 billion projected over 10 years to the federal revenue. The child tax credit. The credit of $1,000 was available for each qualifying child under the age of 17. And this credit was available for any qualifying child with either an ITIN or a Social Security number. The AGI income phase-out for the child tax credit was $75,000 for a single person, head of household, and qualifying widow or widower, $55,000 for married filing separate, and $110,000 for married filing joint. And for each $1,000 in adjusted gross income above this threshold, the child tax credit would be reduced by $50. Now again, these were 2017 rules. The TCJA, the credit has increased from $1,000 to $2,000. It's available for each qualifying child under age 17, no change. Each child claimed, however, must have a valid Social Security number issued before the original filing date of the return. A qualifying child with an ITIN no longer qualifies for this portion of the child tax credit. The adjusted gross income phase-out for 2018 will be $200,000 for single, head of household, or qualifying widow and married filing separate, and $400,000 for married filing joint. For each $1,000 in adjusted gross income above these thresholds, the child tax credit will be reduced by $50, which was the same as the previous formula for 2017. The additional child tax credit has technically been eliminated. $1,400 of the new child tax credit is now refundable, whereas in the past $1,000 for that old additional child tax credit was refundable. The maximum refundable portion of the new child tax credit is 15% of your taxable earned income over $2,500. The previous threshold for the additional child tax credit was 15% of taxable earned income over $3,000. So, the income requirements to receive the refundable child tax credit have changed a little bit. So if we look at one child, this top line, taxable earned income needed in 2017 to receive the $1,000 credit was $96.67. Now, the taxable earned income needed in 2018 to receive the $1,400 max credit has gone up a little bit, $11,833. And again, that's on that top line looking at one child. You can see in the last column the taxable earned income needed in 2018 to receive the $1,400 max credit has gone up in every category. Let's look at a breakdown of the maximum EIC and the maximum child tax credit. We'll look at the middle column there for two children. The 2017 maximum EIC was $56.16 with two children. The income range was $14,000 to $18,349, and the income needed for the maximum child tax credit in 2017 was $15,833. For 2018, for two children, maximum earned income credit $57.16. The income range has gone up a little bit, $14,000 to $18,699, but look at the income needed for the maximum child tax credit, $21,166. Let's go back and look at that 2017 slide. $15,833 for two children. And again, for 2018, income needed for the maximum child tax credit, $21,166. Quite a difference. So, if we look, the income range for maximum EIC, $14,000 to $18,699. The income needed for the maximum child tax credit, considerably more, $21,166. And again, for three or more children, $14,000 to $18,699. The income needed for the maximum child tax credit, $30,500. So, the point of all of this, the income needed for the maximum child tax credit and the income needed for the maximum EIC are considerably different. So this is going to make a big difference on some of your clients' tax returns. There's a new $500 non-refundable credit. Continuing on with the child tax credit, a new $500 non-refundable credit. It's available for each qualifying child over age 16 claimed on the return, and it's available for each qualifying relative claimed on the return. To claim this $500 non-refundable credit, the qualifying child or the relative needs a Social Security number or an ITIN or an ATIN, ATIN, as long as they're residents of the United States. They can qualify if they're residents of the United States and have an ITIN or an ATIN, the Adoption Tax Identification Number. No longer eligible if a resident of Canada or Mexico. So the highlights of the child tax credit: the credit's gone from $1,000 to $2,000 for each qualifying child, 16 and under. There's a new $500 credit for qualifying children 17 and older or qualifying relative. The income threshold is 15% of earned income over $2,500. Previously it was over $3,000, and the phase out has been increased to $200,000 for single head of household, married filing separate, and qualifying widow or widower, and $400,000 for married filing joint. Continuing on with the highlights, a valid Social Security number will be required for the new child tax credit for 2018 tax returns. The refundable portion of the new child tax credit will be $1,400 for each qualifying child, age 16 and under. A dependent that's a resident of the United States who has an ITIN is eligible for the non-refundable $500 child tax credit. So, continuing on with our table, the changes to the child tax credit will cause a deficit of $562 billion projected over the next 10 years in federal revenue. Next, the health coverage mandate penalty. The shared responsibility payment: currently all persons covered by the Affordable Care Act, Obamacare, must have either minimum essential coverage or exemption from coverage. The health coverage exemptions are claimed on Form 8965. Individuals who do not have coverage or an exemption are subject to the shared responsibility penalty. The penalty is calculated on the shared responsibility worksheet, and it's entered on Form 1040, line 61, as an other tax. The current shared responsibility penalty or payment is the greater of the following: 2.5% of household income in excess of the taxpayer's filing threshold, or $695 per adult and $347.50 per child on the return. And the penalty is 1/12 of the annual responsibility payment for each month the taxpayer or any other person on the return lacks coverage or an exemption. And these amounts are scheduled to be adjusted later this summer for 2018 based on inflation. Commencing with tax year starting after December 31st, 2018, the penalty has been reduced to the following: 0% of household income that's in excess of the taxpayer's filing threshold, and $0 per adult and $0 per child on the return. Again, this is for 2019. It's not effective on 2018 returns. The TCJA did not technically repeal the mandate or any other requirement of the Affordable Care Act. It just reduced the penalty to 0 starting in 2019. This reduction of the penalty doesn't expire in 2026. It's considered a permanent change. For the current tax year, 2018, the shared responsibility payment and all other aspects of the Affordable Care Act remain in effect. In regards to the shared responsibility payment and Obamacare, a Kaiser Family Foundation health tracking poll released in April found out that 40% of those surveyed did not know that the penalty for not having health insurance has been repealed, and 21% were aware it had been removed but thought that it took effect immediately and that they didn't have to have insurance in 2018. So the individual mandate penalty will add $314 billion projected over the next 10 years to the federal revenue. The alternative minimum tax and the TCJA's effect on AMT. The TCJA raised both the exemption amounts and the phase-out amounts. AMT exemption amount is the amount of income that a taxpayer deducts from their income when calculating the alternative minimum tax. The AMT phase-out amount is the income threshold where the exemption amount starts to be eliminated. And here's a comparison table of the 2017 exemption amounts for the alternative minimum tax versus the 2018 exemption amounts. And notice the single exemption amount, $54,300 for 2017 as opposed to $70,300 for 2018. Married filing joint, $84,500 for 2017, $109,400 for 2018. Now let's take a quick look back at that slide. What does an exemption amount mean? It's the amount of income that a taxpayer deducts from their income when calculating the alternative minimum tax. The phase-outs for single person in 2017, $120,700, $500,000 for 2018. Married filing joint for 2017, $160,900. Married filing joint for 2018, $1 million. And again, let's review, what does that phase-out amount mean? The phase-out is the income threshold where the exemption amount starts to be eliminated. So as you can see, substantial changes for 2018 in the alternative minimum tax. Now, in addition to the exemption and the phase-out amounts, many of the parts and pieces that go into the calculation of the alternative minimum taxable income will change. This is the 6251, the form that calculates the alternative minimum tax for 2017. And these are the component parts of the AMT that are being affected by the Tax Cuts and Jobs Act. And significantly fewer returns should be impacted by the AMT because of the much higher limits. So raising the AMT exemption and the phase-out will change the federal revenue, and it'll have an adverse effect on federal revenue of $266 billion projected over 10 years. Next, miscellaneous individual changes. Pre-TCJA, long-term capital gains rates were 0, 15, and 20%. The 0% rate applied to a taxpayer in either the old 10 or 15% tax brackets. The 15% rate applied to a taxpayer in any of the old 25, 28, 33, and 35% tax brackets. And the 20% rate applied to a taxpayer in the old 39.8% tax bracket. Going forward, long-term capital gains rates remain 0, 15, and 20. However, the capital gain rates no longer align with the new tax brackets that are being brought about by the TCJA. Instead, they somewhat align with what the old tax brackets would have been before the passage of the Act. The old brackets being adjusted for chained CPI instead of the old Consumer Price Index. So miscellaneous changes, capital gains for single person. You can see the 2018 ordinary income single tax rates, the 12% tax bracket, 95.26 to 38.7, aligns with the 0% tax bracket, 0 to 38,600, so they don't quite match up. In the 35% tax bracket down there, $200,000, $1 to $500,000. Lines up with the 15% tax bracket for the capital gains. Doesn't quite line up. Notice $425,800. In the 37% tax bracket for 2018, the ordinary single tax rate, $500,000, $1 and above. Lines up with the 20% tax bracket. Not quite. $425,801 and above. So you can see there's a little bit of non-alignment going on there. And here's a brief look at the same thing, same concept for married filing joint, the 2018 ordinary income tax rates and the 2018 capital gain tax rates don't quite match up. So hopefully by the time tax season rolls around, Congress will have some guidance for us on this, or the IRS will have some guidance on this, and these brackets will line up a little bit better as far as ordinary income and capital gain tax rates. Moving through our miscellaneous changes brought about by the Tax Cuts and Jobs Act, next the Kiddie tax. Form 8615 is the form used to calculate this. It's the tax for certain children who have unearned income. Kiddie tax applies to unearned income for children under the age of 19 and students under the age of 24, and there are some exceptions to this provision. The child's parents are deceased, or the children have sufficient earned income to support themselves without any consideration of this unearned income. Under the previous law, the child's earned income is taxed at the child's tax rate. The child's unearned income above an indexed threshold, 2100 in 2017, is taxed at the parent's top marginal rate if the parent's rate is higher than the child's rate. The old rates were 10, 15, 25, 28, 33, 35, and 39.6%. Under the TCJA, a child's unearned income will be taxed at the capital gain and ordinary income rates that apply to trusts and estates. So let's look at the 2018 ordinary income Kiddie tax rates. 10% tax bracket 0 to 2550. The capital gains rates 0% tax bracket 0 to 2600. 24% tax bracket 2551 to 9150 for ordinary income. The 15% capital gain rate 2601 to 127, and so on down the line. Under the Tax Cuts and Jobs Act, the child's earned income is still taxed at the child tax rate. The child's net unearned income above a threshold, which again remains at $2,100, are no longer taxed based on the parent's marginal rates. The TCJA will have little impact on a child with parents in the highest tax brackets, but a child with parents with taxable income of less than $400,000 may be subject to higher tax rates if the child has more than $2,101 in this unearned income. And so, wrapping up the miscellaneous changes that the Tax Cuts and Jobs Act will bring about, like-kind exchanges. Starting in 2018, only real property qualifies for a like-kind exchange. Meals, on-site meals provided at the convenience of the employer can no longer be deducted at 100%. Think about all those folks that work with you during tax season. Going forward, on-site meals are subject to the 50% rule that applies to any other meal deduction. Entertainment, previously, entertainment expenses were subject to the 50% rule. Now, entertainment expenses are no longer deductible. What sorts of changes or major changes will the TCJA bring about for businesses? Well, lowering of the top corporate rate from 35 to 21%, creation of a 20% pass-through deduction, changing the Section 179 and the bonus depreciation limits, limiting the net operating loss deduction, limiting interest deductions, elimination of the domestic production activity deductions, a territorial system of income reporting, and modifying or eliminating certain business deductions and the corporate alternative minimum tax, and raising the estate tax exemption. Probably the ones that we'll see most often, or the ones that will have the most impact: creation of a 20% pass-through deduction, limiting the net operating loss deduction, and limiting the interest deductions. And this concludes Part 2 of our presentation of the Tax Cuts and Jobs Act and the effects on individual tax returns. Thanks for watching.